Hello everyone and welcome back. I am absolutely thrilled to have you here for this brand new explainer on the GAAP Advisors Ind AS Clinic YouTube channel. Today we aren't just looking at some dry, boring accounting rule. We're going to crack open a real-world accounting dilemma, the kind that literally trips up even seasoned professionals. So if you're the kind of person who likes solving a really good financial puzzle, you are in exactly the right place.
But hey, before we get too deep into the weeds, let's ask a pretty vital question. Why should you, or really any person investing their hard-earned money in the shares of listed companies, care about the finer details of these accounting standards? Well, think about it. You absolutely need to know if a company's balance sheet reflects true objective value, especially when markets take a sudden downturn. Understanding these standards? That's your shield against financial mirages. It tells you for sure whether a company is facing reality or just hiding behind outdated numbers.
Okay, let's dive into this. Here is our roadmap for today. We'll do a quick welcome to the clinic, set up our investor's dilemma, navigate the rulebook, run through the impairment test, and then wrap up with your next steps.
Welcome to the clinic and the GAAP Advisors ecosystem.
So our case study today is pulled directly from the incredibly useful GAAP Advisors Task Weekly newsletter. Specifically, we're looking at an issue featured in the 206th edition, authored by CA Manish C. Iyer, who is the director of GAAP Advisors. There are actually over 230 editions of this weekly newsletter published right now on LinkedIn, so if you're on the platform, you've got to subscribe. It's totally free. And what's really amazing is that this specific issue and its detailed response comes straight from the massive issue repository hosted at gapadvisors.com. That site holds literally over 4,500 resolved issues on Ind AS and Indian GAAP. Anyone can register for free, submit an issue, and get a detailed response delivered directly to their inbox. If you're an auditor who needs to explicitly document how you addressed a specific Ind AS application, this is an absolute must-have tool for you.
Now, just to make sure we're all on the exact same page before we get to the dilemma itself, let's quickly set our baseline rules. For our environment today, the functional and presentation currency is the Indian rupee. Any currency other than the functional currency, that's considered foreign currency. And our standard reporting period runs from the beginning of April 1st to the end of March 31st. Okay, simple enough, right? Let's get to the main event.
Section 2. The Investor's Dilemma. When market prices crash. Here's the situation. Step 1. An investor goes out and buys a solid 20% equity stake in an investee company. The agreed purchase price was based directly on the prevailing market price of that equity in the stock market at the time. Step 2. Because that 20% stake gives them significant influence, this investment is classified as an associate under Ind AS 28. That means it's accounted for using the equity method. It's initially recognized at cost and then adjusted for the investor's share in the profit or loss. Everything is going fine, right? But then, here comes the plot twist in Step 3. Right after the share transfer is officially completed, the market price of that equity crashes. And I don't mean a little dip, I mean a substantial, undeniable downward plunge.
So what does this all mean? Does this massive depreciation in the quoted share price automatically serve as a sufficient indicator that the investment needs to be impaired in the books? And if we actually do need to recognize further impairment, exactly which standard in the rulebook are we supposed to follow? This is the big mystery we're solving today.
Section 3. Navigating the rulebook. Finding the governing standard.
Now, what's really interesting about this slide is the tug-of-war it represents. Many accountants look at an equity investment where the market value has just totally tanked, and their first instinct is to jump straight to Ind AS 109, which covers financial instruments. But on the other hand, we have Ind AS 28, which deals specifically with investments in associates. When you hit a conflict like this, it's kind of like a giant puzzle. You have to look incredibly closely at the fine print of the scope.
And boom, there's our answer. If we zoom in on Ind AS 109, paragraph 2.1a, it explicitly says, and I quote, "This standard shall be applied by all entities to all types of financial instruments except those interests in subsidiaries, associates, and joint ventures that are accounted for in accordance with Ind AS 28. There it is in black and white, guys. Ind AS 109 definitively does not apply to our 20% equity associate that's measured under the equity method.
Oh, and just to quickly dispel a common myth I hear all the time, some folks will ask, hey, should we look at Ind AS 39? The short answer is no way. Ind AS 39 has absolutely not been notified in the company's Indian Accounting Standards Rules of 2015. So actually, scratch that one completely off your list. We can close that door and keep our focus locked in. Section 4. The Impairment Test. Resolving the conflict. So we know for sure we're operating under Ind AS 28.
Now, paragraph 40 of that standard tells us that after applying the equity method, we've got to check paragraphs 41A to 41C to see if there is objective evidence of impairment. And paragraph 41C makes it perfectly clear. It states, a significant or prolonged decline in the fair value of an investment in an equity instrument below its cost is also an objective evidence of impairment. What does that mean in plain English? It means admitting the asset just isn't worth what we paid for it anymore. Because our querist stated the market price went down substantially, this condition is undeniably met. We have to face reality here.
Which brings us to our final verdict. Because the substantial market crash acts as objective evidence under Ind AS 28, the standard then directs the company to actually test that investment for impairment in accordance with Ind AS 36, impairment of assets. And that, my friends, is exactly how the rulebook links together to ensure the balance sheet reflects absolute reality.
Section 5. Your next steps. Join the GAAP advisors community. I want to enthusiastically thank all of you for spending your valuable time with me today to unpack this standard. If you found this explainer helpful, please hit that like button, drop your thoughts in the comments below, and make sure you subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And please, help us spread the knowledge of Indian accounting standards. Share this explainer among your contacts, colleagues, your audit and finance teams, and especially with any students you know who are currently pursuing their CA course. It benefits the whole financial ecosystem.
To stay ahead of the curve, make sure to follow the GAAP Advisors Ind AS Clinic channel on WhatsApp. That's where you'll get immediate updates on new explainers, podcasts, newsletters, new issues we've responded to, and any new standards issued. Don't forget to subscribe to the free LinkedIn newsletter we talked about earlier, too. Now, if you have specific thorny issues on Ind AS or IFRS that you are personally struggling with, you can actually book a one-on-one consultation with the author, CA Manish C. Iyer, right from his page on topmate.io. And lastly, for an even deeper dive into the nuances of the issue we dealt with today, connect to the GAAP Advisors Ind AS Clinic podcast, which is available right now on Spotify, Amazon, or YouTube.
Just a quick note before we wrap up. The views expressed herein are the personal views of the author and are not binding on the audience. We always request that you seek the help of a qualified expert before taking any action or refraining from any action based on the views discussed in today's explainer.
I am going to leave you with this final, provocative thought. If an associate in your portfolio sees its market value absolutely plummet tomorrow, are your books legally and structurally ready to reflect the real story? Will you know exactly which standard to apply? Keep learning, keep questioning, and I will see you in the next explainer.